I think the next move up and down is at hand. Gold has already made the statement. Okay, gold has roared up through the highs. Now, we've been bearish gold, we've been bullish gold. But right now, I think the drama that we're about to see in the next year, I don't think it's going to take 3 years or anything. I think this coming 12 months is going to be very dramatic in major markets, one direction or the other way. And they'll be moving, like stock market will be moving opposite gold, opposite T-bonds. But the drama will be far more in terms of price dynamics than we're used to. And I don't think it's going to take years to reach these critical levels.
The gold market has gotten ahead of itself and is due for a further correction after a relatively quiet week following its breakout to record highs, according to one major British bank. Momentum and technical analyst Michael Oliver predicts market drama in the next year, expecting major movements in various markets, including gold. Despite modest dollar gains, he highlights gold's substantial increase since December 2015, indicating alternative factors driving its trajectory. Somewhat ironically, gold was attractive due to all of the money printing that had occurred previously. Dollar debasement was one of the biggest attractions for investors. But now that the US dollar is strengthening, gold is starting to be used to protect wealth, meaning that both the US dollar and gold are rising. Given the correlation between gold and the bond market during market stress, Oliver suggests a potential concurrent rally in both assets. While highlighting historical examples, he notes that gold prices surged alongside T-bond prices as the yield dropped during 2007. Gold's inverse correlation with US benchmark 10-year bond yields has been minus 0.84 over the past month, with the inverse relationship with US 2-year yields a little weaker at minus 0.77. Interestingly, the relationship with the DXY has been weakening, sitting at just minus 0.29. While correlation does not automatically mean causation, it's safe to say it is when it comes to gold. Michael Oliver reflects on his past bearish stance on gold during its peak in 2011 and 2012, followed by a significant crash in 2015. He underscores signals hinting at potential upward movements in gold and silver mining equities, implying a revival of momentum after a temporary halt. In anticipation of the incredible gains the junior sector will begin to experience once the gold price prints a technical breakout above $2,100 on a monthly closing basis, the Junior Miner Junkie newsletter has accumulated a basket of quality juniors with 3x to 10x upside potential into 2025 and 2026. Now, we present the clips of Michael Oliver's insights from his recent interview with Soar Financially. Before we continue to delve into this discussion, please subscribe to our channel and activate the bell icon for timely updates.
For the last year and a half or so, there's been a good inverse correlation between the dollar index and gold. Opposites, okay, I'll give you that. But when you go back to the gold's bare low, it was in December of 2015, at a price of 1,046, okay, so 1,050. Go back to December of 2015 on the dollar index, and you know where it was? Around 97. Okay, so what is it? It's now been, nearly a decade, and the dollar index is up, 5%, and gold's more than double? Okay, so if you only looked at the dollar index from a long-term point of view and said, well, gee, the dollar index up 5%, gold's probably down over the last 10 years, right? But it's not, it doubled. So it's not much of a help on the bigger picture. However, if you get some dynamics in the dollar, meaning you break something that causes it not just to ooze, but to actually push a bit, and we think those are just below the market, that's when you'll get the dollar suddenly becoming wind at the back of gold again, because of the drama of what's going on in the dollar. No longer incremental, but noisy. I think that's about to happen.
Yeah.
Correlate over long-term periods of time, but go back to 2000, when the stock market was topping, punch up a gold chart, you'll see it was at major lows, making a bottom. 2000, 2002, stock market went down big, gold went up big. Same period of time on T-bonds, T-bond yields dropped sharply. T-bond prices went up during 2000 to 2002. 2007, Fed cut rate in September of 2007, about 4 weeks before the top in October 2007. Around October, quarterly momentum of T-bonds, which has the same setup it has now, where then it was a gradually downtrending line going back about 2 years, where you couldn't see it on the price chart of bonds, but on the momentum you could see the structure. You broke through it around October of 2007 when the stock market was making its final high, and T-bonds started to dramatically rise. And they rose, I think, for the next year plus, sharply. So did gold at the same time that T-bond prices were rallying. So there was a correlation between price direction of gold and price direction of T-bonds back in 2000 and 2007 through 2008. And I think we're about to see that again. We were bearish at the top in 2011 and 12. In fact, we got major bearish in January 2012. The high had been made in October 2011. Okay, so we get bearish a couple months off the high. What happened for the next year in gold was 2012 oscillated in a range, but could never get back to the 1920 price high that occurred in 2011. But it felt good for the longs. It felt like, hey, it's hanging in here. It's looking good. It was a laborious top after an aged bull market. In 2013, we crashed. After the 2015 low, gold was 1,050. At 1,140 in February of 2016, annual momentum had the same kind of ceiling that we've got right now on silver and gold miners. It broke through. We turned major bullish. Price of gold then was $1,140, so $90 off its low. Nothing has changed the trend direction of annual momentum since then. Yes, we've had sharp pullbacks, but annual momentum has not broken its integrity. And now, in the case of silver and the miners, it's created a new secondary breakout level that says, okay, after this laborious pause that we've been in for the last 3+ years, we're going to re-engage that ongoing annual momentum trend. And I think we're at the door. But that's when so we've been bearish gold, we've been bullish gold. But right now, I think the drama that we're about to see in the next year, I don't think it's going to take 3 years or anything. I think this coming 12 months is going to be very dramatic in major markets, one direction or the other way. And they'll be moving, like stock market will be moving opposite gold, opposite T-bonds. But the drama will be far more in terms of price dynamics than we're used to. And I don't think it's going to take years to reach these critical levels.
Michael Oliver believes significant market shifts are imminent, particularly in gold, silver, and the dollar. He points out gold's recent surge and mentions that annual momentum indicators drive the potential breakout of silver. A record-breaking rally for gold may yet continue, particularly as investors position for interest rate cuts. But analysts say silver appears well-placed to outshine the yellow metal in the second half of the year. Gold, which is typically considered a safe haven asset at times of financial uncertainty, has rallied despite high interest rates and a relatively strong U.S. dollar. Oliver points out a recent increase in interest from major asset managers and gold miners, foreseeing potential gains that could surpass gold itself, drawing attention from investors. Gold stocks are in a much better position now that gold has broken out of its 13-year cup and handle pattern and likely started a new secular bull market. Let's get back to the interview.
I think the next move up and down is at hand. Gold has already made the statement. Okay, gold has roared up through the highs. Now, every time gold makes a new high over the last couple of years, even the gold bulls say, don't trust it. The problem is that they don't realize that they've been caught in a abnormal range of action for at least since 2020 highs in gold, silver, and the miners, especially in silver and gold. In the range of price action is very narrow, and what you consider to be overbought now, using some metric that's popular, let's say RSI or MACD, is only overbought based on the behavior of the market over recent years, which has been unduly subdued. You get a logarithmic chart of gold or silver, go back 50 years and look at the last 3 years, and it's like a clump of ink. There's hardly any inhale or exhale. Yeah, you look inside of it and you can see some, but it's really narrow movement of price. And so all of the metrics that say this is overbought market, sell it, those have worked for the last couple of years. But we say that when gold got up through the 2100 level 2 weeks ago, we wanted it over 2118 on a weekly close. It did. It closed well above there 2 weeks ago. That was its breakout on some long-term metrics that say, okay, game changing. Silver is now trading at levels that if it closes a month anywhere around today's high, its annual momentum says, I'm launching. As you look at a price chart of silver, you don't see any particular level that says, oh, I'm going to launch. When you look at annual momentum, it's a perfect ceiling. It's been hit and hit and hit and hit. Very shallow level. So when you look at momentum, you see a structure that, gee, if that comes out, we're going to go up. And it will. The tone of the market will change. It's already beginning to. You can see how silver's behaving the last few days, especially. And the miners will change. They're in the same technical position as silver. So we think they're about to shift. Okay, let's shift to another market. We know the dollar is weakening. Okay. There's some levels below, basically under the $100, 100 point level on the dollar index. Right now it's trading 102, 103. It's laboring around for the last year and a half, really, in a narrow range. You break that, and the dollar is going to start to move precipitously to the downside. This is based on annual momentum. They inhale and exhale more dramatically than gold. And right now, we've said in recent reports, and this is a true statement, almost anybody can see it, look at the charts, that gold miners have never been so underpriced, both in relation to an ounce of gold and in relation to, let's say, GDX or XAU index compared to the S&P 500. It's the most undervalued asset category on the planet, as far as we're concerned. And it's not going to zero. Yeah, some miners might because they get taken over by some country. But basically, the mining sector is so undervalued that, if you didn't look at charts, but you only looked at underlying value, you'd say, I don't care about timing. I got to own this thing. Its risk reward is too great. I've got to participate in it. The risk is trivial compared to the potential reward. You may not even have a sense of the timing. I'm arguing now the timing is now. And I think some of these large asset managers, like who was it?
Was it Druckenmiller?
Stanley Druckenmiller, yeah.
Yeah.
And he was followed by a couple others. I mean, 3 or 4 weeks ago, suddenly openly committed. He was dumping a lot of tech stocks and putting them into gold miners.
Barrick by Newmont and Barrick, I believe. So.
Yeah, the blue chips. And you can see it reflected in the price action. In fact, after he bought it, it went down a bit, but then it's exploded since. And I think it's a vastly oversold market. What do oversold markets do? If they're oversold and outsold, in other words, everybody who's going to be bearish is already short, okay? When it goes up, there's no sellers. There's a void. And I think we're literally at one of those points now where the volcano could erupt. And so on a percentage basis, if gold does what we argue it's already signaled that it's going to do, namely resumption, the miners will come out of this hole at a double or triple pace as gold on a percent gain basis. So I think it's a place to be primarily focused.
Analysts expect that gold prices may remain above $2,000 per ounce even later in the year, reaching new historical highs. While prices could increase, there is little historical support for prices over $2,000. Since 2010, gold futures have only closed above $2,000 33 times, equating to 1% of the time. How do you envision the future trajectory of gold and silver amidst ongoing market uncertainties and the potential for interest rate cuts? Drop your thoughts in the comment section below. If you find this video informative, don't forget to support our channel and turn on notifications to stay informed about our latest videos. See you in the next video.